In this video, I'm going to give you the top 15 things that you need to know and understand and be able to do in order to be an amazing investor, especially in the stock market. Stocks and this whole world of investing is very complicated, which is why I made this channel to make investing simplified. So what I'm going to recommend is that you take each one of these 15 that I'm going to teach you today, and I want you to focus on each one for a full day. And if you do that, by the end of 15 days, you'll be able to crush that stock market and be well on your way to financial independence. Along with the 15 topics that I'm going to introduce in this video, what I'm going to recommend is that you pick at least one of these 4 books here. Each one of these 4 books totally changed my life financially, and I'm betting they're going to do the same for you. I definitely suggest that you read all 4, but I am a professor. I'm used to talking to students about reading. And I also know that reading a bunch of books is overwhelming. So if I can just get you to read 1 out of 4, that's a win for me. The 4 books are Rich Dad, Poor Dad, The Intelligent Investor, Trillions, and then The Essays of Warren Buffett. I'll link to each of these below in the description, and let's get to number 1. So this list isn't necessarily in order as far as you don't have to do number 1 first, but I try to make it in a somewhat systematic way that if you learn about the first thing, then maybe the second thing might be a little bit easier because you will have thought about some of the stuff that you need to go on to the next thing. So anyway, number 1 is all about understanding where to put your money when you're investing and why specifically you're picking that area. This would be something like retirement versus a brokerage account. It might also be understanding the difference between a 401k versus a traditional IRA versus a Roth IRA. And also for absolute beginners, this might even be which investing platform should I use. They all look kind of scary and confusing, but my rule of thumb is that the goal here is substantial life savings money. So I want it in the most reputable place possible. Yes, Robinhood and M1 Finance have cool, fun platforms, but they're unproven and I don't feel very comfortable. I like Charles Schwab personally, but also would recommend Fidelity or Vanguard. Now in this video, I have 15 topics to cover, so I'm not really going to go very deep into any one of these topics. This is more so for you to have a list to be able to go, okay, now I need to know that I need to figure out where I should invest, or specifically, is this for retirement or for something more short-term like 5 years? By doing this, I think I'm giving you a jumping off point to be able to conduct your research and use my channel as a start, but then I hope you go deeper in the areas that you actually need to. And lastly here for number 1, the reason why I made this number 1 is because when I first started, all I was thinking about was retirement. All I heard about was this compound interest, and so put some money in and 40 years down the road, you'll have this amount of money. And that sounds great, and that is great, and most of your money probably should go towards retirement. But then I started seeing, oh wow, 5 years from now, I probably want to buy a house, or I want to have some money saved up for other things. And so I wish I would have put a portion of it into a brokerage account and a portion of it into my Roth IRA and 401k instead of all into retirement. But it's not the worst mistake in the world because now I have a lot more in retirement, so I'm pretty set there. But it would have just been nice for me to consider when I first started investing. Number 2 is to start looking at the difference between dividend stocks and just stocks that are there to appreciate. On this channel and in real life, I get questions a lot like, why should I invest in this stock if it doesn't give me a dividend? Or this stock is better than this stock because the dividend is higher. What I want you to do is figure out what is it that you're investing for. Do you want that cash flow every month or every quarter in the form of a dividend? Or are you totally okay just throwing money into like an ETF or maybe a stock like Berkshire Hathaway that doesn't produce any dividend, but it should grow and appreciate to much higher down the road? And there is no right or wrong answer. The only answer that works is the one that works best for you and what you're doing this for. Just know that there are different types of stocks, different types of ETFs with different goals or different ways for you to be able to make your money. One strategy that I hear a lot that I actually do like is one where you put a lot of money into appreciating stocks or ETFs now, and then let them grow, and then 15, 20 years down the road, when it's grown to this big amount, you take it out of those funds and you throw it into dividend stocks or ETFs, and at that point now that big amount is bringing you a dividend every quarter for the rest of your life. Number 3 is to understand that there are different sectors. This is what's meant when people say that you should diversify, which means you shouldn't put everything into like technology stocks. Some of the different sectors are information technology, consumer staples, financials, healthcare, energy, consumer discretionary, and much more. None are better than the others, but it's just very important for you to understand why you need to diversify or why you might need to put some of your investments into different categories. The main reason is that let's just say you put all of your money into tech stocks and for some reason technology just dies or something happens, then all of your money just dies out too. Now, I don't think technology is just gonna die, but you get the point. Something could happen in that one sector, and so you'd like to have money in other places so that you can kind of balance it out. Mitigating your risk overall as an investor is one of the most important things you can do, which is why I advocate so much for ETFs on this channel, because when you're buying an ETF, you buy one share, but within that share, you're buying hundreds, maybe thousands of other companies, and you have a small piece of each one, and it's usually very diversified, especially in broad funds like VTI or VOO. And that next one, and number 4, is just understanding, do you want to invest in individual companies or ETFs or index funds or mutual funds, which are kind of all the same thing to a certain extent. And the answer here does not have to be either or. I invest mostly in ETFs, but I also have a couple of individual company stock as well. Again, the theme of this video is going to be, you just need to understand why you're picking what you're picking. One of the main things that I want you to learn here is when you're trying to pick an ETF, what I want you to do is type in whatever that ETF name is, and then the word holdings. And what you're gonna find is you're gonna see what the top 10 holdings are for that ETF. And more than that, I want you to click into it and see all the different holdings. This is basically what companies are being invested in when you buy this ETF. And it's important, especially if you're going to be buying multiple ETFs, so that you don't have fund overlap where you're just investing kind of in the same exact thing, but just calling it different names. Like if you invest in VTI and in VOO, it's technically not like negative for your portfolio. You're not gonna like lose any money because of that. But what's happening is you're basically investing in the same thing. Their top 10 holdings are very similar because everything is market cap weighted, which we'll talk about in a little while. So get familiar with the terms holdings and then also fund overlap. Number 5 is to start analyzing things through different time periods. If you just look at the price of a stock today and it says something like it's down 4%, that can't be the last thing that you look at that makes you decide if you're gonna make a buy on that or not. If you then click and see over the last year, actually it's up 20%, that tells you a whole different story. And then if you click again at the 5-year mark and it says, actually overall it's down 20%, in the last 5 years, that's telling you an entirely different story altogether. My rule of thumb when I'm looking at things is definitely to look at least 10 years worth of data. Because if you only look at something for the past year or 2 or something, and we've been in like a crazy bull market or something, then that's not very indicative of what it might do down the road. But usually 10 years has at least 1 or 2 bad years in there with a couple of good years, and it averages out. For the most part, you are investing for long-term wealth, and so you want to look at the longest term data possible to just give you a good picture of what this fund or company stock has done over a good amount of time. Next is PE ratio. The PE ratio helps investors determine the market value of a stock as compared to the company's earnings. In short, the PE shows what the market is willing to pay today for a stock based on its past or future earnings. The average PE for the S&P 500 has historically ranged from 13 to 15. A company with a current PE ratio of 25, above the S&P average, trades at 25 times earnings. The high multiple indicates that investors expect higher growth from the company compared to the overall market. A high PE does not necessarily mean a stock is overvalued though. I like my PE ratio to be closer to 20, but again, the deeper that you start to understand why you're investing in certain funds or certain companies, you'll start to understand that maybe that PE ratio isn't necessarily something that you even need to look at based off of why you're investing in it. Now at this point, you've learned a couple of different things, and hopefully you've taken a couple of days to really dive deep into each of these things. You've also been reading at least one of the books. And so at this point, what I'd recommend you do is start to build out a list of stocks or ETFs that you're wanting to watch. You can use any platform and there'll be a section to build out a watch list, and just start adding a couple stocks and ETFs that you find appealing right now. And each and every day, I want you to look at the price at the beginning of the day and at market closing, which leads to the next section, which is all about watching to see how the news affects the market. So the longer you're doing this in-depth research, the more you're going to see that there's certain things that move markets more than others. And most times it doesn't even have to do with the business itself. It doesn't have to do with their earnings. It doesn't have to do with their competitive advantage. It doesn't have to do with a lot of those things. It usually has to do with economics, and not just regional economics or even within your own country, but overall world economics. Right now though, in the United States specifically, every time that the Fed decides to increase that interest rate, the market does something crazy every single time within minutes of that announcement. It's just important to understand this psychological shift and things that happen emotionally, because for a lot of newer investors, they'll invest in a certain stock, and then if they wake up the next day and it's down 5% and now they've lost 5% of their money, they get really scared and maybe they'll just sell out of it saying, oh no, we've lost 5%, I'm probably gonna lose more. And most likely by the end of the day, if not by the end of the week, the market will have recovered because the emotional response will have been mitigated at that point. So again, we're trying to find the deeper reason as to why markets move and what's actually happening there. The next things to look at would be market cap or AUM, which is assets under management. So market cap would be for like an individual company stock. And what that's basically saying is, how much is this company worth? We have a couple companies worth a couple $1 trillion, and then you have small companies that are under $1 million. The reason why you want to know what the market cap is because usually a company that's much, much bigger is a little more stable because they have a lot more money coming in, and so they're not likely to just randomly go out of business. It's just not very likely that Apple's going to go out of business like next month. Same thing with assets under management. This would be more for your ETF / index funds or mutual funds. What's happening here is that this is a fund with a bunch of companies, and so there's actually a fund manager and a company that's running this, and they're the ones actually buying up all of this stock to put within the fund. And so just like market cap, the more assets under management that a fund has, the more stable they possibly should be, but also this should just add to liquidity, which should mean that you should buy and sell easier, and overall it brings risk down a bit, but it isn't necessarily the thing that's going to move the needle left or right. It is just something that you do need to understand and you need to take into consideration when you're looking up your next ETF or individual company stocks. Now the next couple ones here have to do with how you can actually analyze and look up information on individual companies, because whether you're investing in an individual company or an ETF, you still need to understand what companies are within that ETF and how they run and how they're doing, because that's the reason you're picking these things in the first place. So the first place that you're going to want to do your research on any of these huge public companies is going to be looking up the company's 10K. It's super easy. Like if you wanted to look up Apple's 10K, you could just type in Apple Company 10K on Google and it'll just pop up. And that thing is packed full of information. You could sit there for weeks and read everything about what the company did over the last year. You can look at the management structure. You can look at what they're planning to do or strategy over the next couple years. They might talk about their market position. They might talk about how exactly they're going to be using the funds over the next year or two. This thing is a wealth of information, but it's one of the last ones that I'm going to talk about here today because you'll definitely get overwhelmed if you go there first without understanding a lot of the other stuff that I talked about first. Next on this list is one of my favorites personally, and that's company earning calls. Companies most often conduct earnings conference calls immediately following the release of financial results, typically at the end of each quarter. Real-time online streaming has allowed average investors to access conference calls, which can be found easily on the investor relations sections of companies' websites. If you know me, you know that one of my favorite companies is Berkshire Hathaway, and I love when Warren Buffett and Charlie Munger get on there and they just talk about what's happening in the company. It's usually the company's CEO, but sometimes other directors and managers have things to say as well, and it's just interesting to hear the insights directly from these people. Next on the list is to look up the company's or even ETF's competitive advantage. Now this one's not so cut and dry like the other ones, where you can just type this in and it'll just pop up. This one takes a little bit of digging, and again, it's for those that really care and want to go a little bit deeper, but I absolutely recommend it. While most of the other stuff is quantitative, this one's a little more qualitative and more soft skills. For me personally, I like to look up a company's moat versus other companies. For example, Disney and their theme parks. The competitive advantage that they have there is that a competitor can do all that they want to try to build something that Disney's built, but it's going to take a lot of time, a lot of money. Disney is far ahead on that. The Disney parks are just far superior, and the tribe that they've built of Disney people is just insane. So look for the competitive advantage that the company that you're looking to invest in might possibly have, and just make sure that it's actually big enough. They don't necessarily need to be the leader in the space, but they do need to have something that other companies don't have, or a reason why they're gonna be around in 10 years. Because if not, why are we investing in them? The next thing that you need to have on your mind is not a fun one, but it's one that you definitely need to understand, which is taxes. I'm definitely not going deep on this one because this could be its own video, but anytime that you make money, anytime that you make a gain on your stock, you have to pay a tax on that. Now, if your stock goes from $10 to $30, you don't have to pay taxes until you sell that stock. So if you just hold it in the stock market for 5 years, you won't pay taxes each year. But on that 5th year, if you sell it and you make $100, then you're gonna have to pay a certain amount of tax for that. Your tax depends on a couple of different things, mostly what your income is per year, and that'll tell you what tax bracket it's going to be in. It starts to get a little more complicated when you talk about dividends, because with dividends, the company is technically paying you, and so you're making a gain. And so even if you're reinvesting those dividends back into the stock and never actually use the dividend, you're still gonna have to get taxed on that, even though it's gonna be a very, very small amount. All that to say, definitely look into the taxes and how that works for you specifically. All right, so while all of the rest of the things that I talked about before do have to do with you technically, they more have to do with understanding just stocks in general and companies and ETFs and the different types of platforms. These next 3 are all about you specifically, and this is what's gonna set you up for financial freedom and be the difference between you actually making a crazy amount of money in stocks or not. The first one here is going to be your goal for investing. Are you investing just to have like a solid retirement? And if so, that's amazing, that's perfect. But is that the reason why? Other reasons could be things like, I'm trying to save up for a super huge purchase, but not for like 10 years, and so I'd like to make that money a little bit quicker. Maybe you wanna buy a house way down the road. It could also be something like investing for your child's future, like college, or maybe you wanna give them a gift when they hit 18 years old or something like that. You can have multiple reasons why you're investing in multiple ways, but just understand why you're doing that and definitely have that solidified before you start investing. This one should technically be the first one that I talked about overall, but then again, it could also be in this type of order, because a lot of people that I know, and even myself, invest for a little while and then you have a different season of life or things change, and so now you have a different reason to invest, and so you do things differently. And that's totally okay. Check in periodically with yourself, with your family, try to figure out what's best for you then and there, and then start to make steps towards getting to whatever it is that your goal is. The second to last item on this list is all about your disposable income, so figuring out your budget. At some point, it's going to be less about, well, I don't know where to invest or how to invest. Now it's going to be more, I don't have enough money to be able to invest in the way that I want to. All of this is solved with a budget, and most people just glaze over when I start to talk about a budget, but this is the single most reason why I am able to invest as much as I'm able to invest, and literally everybody that I've talked to or worked with, if they don't have a budget, are not able to invest as much or as consistent. And for those that are incredibly wealthy, they all have a budget of some sort. This budget doesn't need to be the same budget or a super strict budget that you would never even follow in the first place. Find a budget that works for you, but at the end of the day, all you need to know is, where are you spending your money? How much money do you make? And where can you cut just a little bit so that you have a little more money to be able to invest with? The last one on this list is the one that's going to be the most deep and also probably the most important, and that's understanding your risk profile. You need to understand you and understand your temperament. Are you somebody who could put the bulk of your life savings into this one account That's hopefully going to make you 10% every year for the rest of your life, but there's a possibility that it drops a bunch every couple years? Or will that keep you up at night and make it so that you're too stressed out to even live? Would you rather make a very, very small amount every single year, but at least it's guaranteed? Something like a high yield savings account or just a savings account in general. You may not make a lot of money on it, but you're also not going to lose any money. For some people, that's the best place to go. For me and most people, it's a combination of things. Most of my investing is very safe in like a broad index like the S&P 500 or even SCHD. But then I have portions of my portfolio that are incredibly risky that could go up like 1,000% in a year, but also could go all the way to zero. That would be things like cryptocurrency or growth stocks and even some forms of real estate. No matter what you come up with here, I made a great video on the most simple 3-fund ETF portfolio that anybody should be investing in. And I'll show you exactly what percentage allocation you should do for each one of those ETFs for your portfolio based on what age you are. Check this video out now and put everything you learned from this video into practice with actual practical examples.